HELOC versus HEI. What's the difference? Let me show you. HELOCs are loans. You borrow, pay interest, and make monthly payments. HEI, no interest, no monthly payments. HELOC adds debt, HEI doesn't. You get cash upfront and repurchase your option when you cash settle, refinance, or sell. HELOC, strict credit and income requirements. HEI, 500 minimum credit score based on your home's value with no income.
What the? Alright, so maybe you guys have seen these, maybe you guys haven't. And if you haven't, consider yourself lucky. I've been seeing a lot of these ads coming across my feed lately, advertising an HEI or maybe an HEA, a home equity investment or home equity agreement, and they're comparing it to a traditional HELOC, which is a home equity line of credit, something that our channel talks about a lot, and saying that a HELOC is inferior to an HEI or an HEA because a HELOC has interest rates, whereas these other products don't have interest rates, right? And they're not considered debt. Okay, but it's still, you're borrowing money. And what they're not telling you in these advertisements is that when you look at the fine print, it's way more risk and downside for you as a homeowner than what they're letting on. They don't expect you to look at the fine print and at the repayment cost at the end of the term. I've heard of cases where people owe maybe 3 or 4 times more than what they would have had to pay with the HELOC. And in the worst case of scenarios, they outright lose 70% equity on their home. How does this even happen? How is this even allowed? Well, HEIs and HEAs largely are unregulated when you compare them to something like a HELOC. An HEI is a home equity investment. So basically, what they pitch to you is that they're going to give you upfront cash in exchange for a percentage of your home's equity, right? So they become kind of like a co-owner of your house, and the lender or the investor, what their upside is when your house appreciates, they get a percentage of that appreciation. It's like 40% in a lot of the contracts that I've seen. Imagine your house right now is $400,000, and in 10 years, 30 years, your house could be worth double, $800,000, right? That's an appreciation of 100%. They'll take 40% of that. An HEA it's even better. This is a home equity agreement. The investor gives you cash, upfront cash, and they say, they promise you all these great things, right? No interest rate, no, this is not debt on your balance sheet or whatever. They give you this cash in exchange for a percentage of your entire home's future value. That word future value is very important because what is future? It's literally day 0 + 1. You sign the dotted line, and the moment after you sign and the contract is executed, you're in the future. So an HEA, in the worst case scenarios, could take up to 70% of your home in equity.
Hey guys, Peter from the future here. I was editing the video and I totally forgot that I didn't mention a very critical part of HEIs and HEAs. One of the most predatory things that they do is they do something called a risk adjustment. It's written in a way that it's like supposed to protect the lender or the investor, but really what it is it steals the house from right under your nose. Basically what they're doing is they're taking a large chunk of your home as soon as you sign that paper. For an HEA, it could be like 30%. So if your house is worth 100, as soon as you sign that document, you only own 70% of your house and they own 30%, like right off the bat. So yeah. Okay, back to the video.
How does this even happen? On their websites, they give you these calculators that show you, oh, it's not so bad. They compare it and make it, they finagle the math so that it's very comparable to like a HELOC. Maybe it's a little bit more expensive, a little bit less expensive, depending on the appreciation. But no one knows how much your house is going to appreciate. The average is 4% year over year, right? And these are 30-year terms. If you default on your mortgage, if you sell your home, if you refinance your home, the term of the HEI or the HEA, it triggers, and you have to pay them back whenever you refi, sell, or default on your mortgage. So you have to be very careful with what you're signing and what you're getting yourself into. So what I'm going to do for you guys is go on their website and do the math, compare it to a regular HELOC with a fixed rate, because there are those that exist, and show you, even in the most bullish of cases, what they're showing you is still not as good as a HELOC. Okay, so this is a HEI cost estimator. It's one of those like website calculators that the lenders have or the investors have on their website. Remember, this is the most bullish case ever. Remember, this is the most bullish case. This is not typically what you're gonna see in real life. They're trying to sell you a product, right? So, okay, let's just assume $450,000 is your current home's value. This is locked. They're only going to give you 10%. I guess this company is only going to give you 10% of your home's value. And the scale, even the scale is crazy. Do you think your house is going to depreciate in value in 30 years? Typically, no. It's going to be somewhere between 3.5% to 5.5%, right? So let's just say, let's be conservative and give them a little bit of advantage. Average growth of 3.5% year over year, and you're doing a 30-year term. Your final home value is going to be $1.2 million, and they take $250,000. Okay, so I'm going to write this down on our handy dandy blank page. So in year 10, it's going to be $1.2 million, 1.26. Okay, the principal, you're only borrowing $45,000, and the appreciation is 3.5, which is your home grew in value about $810,000. Okay, so your cost, what they're charging you, is $245,000. It's not including the appraisal fees and whatever fees that they're going to tack on at the end of this contract, right? So you borrow 45, and on top of that, they're charging you an additional 200,000. And this is like a conservative case because your house may appreciate, depending where you live, more than 3.5% per year. We saw this during COVID. Houses almost doubled in value in like a matter of a year or two. Imagine if that was you took out a HEI during COVID. You'd be owing so much more on your house. All right, so now let's go to HEA. This is a different company, a different calculator. I'm not going to show the company's name, but basically what they say is, let's say $450,000 is your home value and you owe 200,000. They're going to take from you a percentage of the future value of your home. Okay, so in this calculator, we're going to set it to apples. Please can't get to 45, so $46,000 is what you're going to borrow, and they will say we own 18% of your home's future value. So put that into this calculation here. And HEA, we're going to say it also appreciates the same amount. You're borrowing $46,000, and they own 18%. That's $227,000. So you're borrowing 46, and then you have to shell out an additional. Sorry. Okay, and now let's look at a HELOC. We have this amortization calculator. Let me share the screen with you. This is like a loan, a standard, fully amortized loan calculator. We're borrowing $45,000 from a HELOC, right? And there's a interest. It's a 30-year term. Interest rate is 9%. It could vary. This is just an example. Right now, current interest rates for a 30-year fixed mortgage is between 6 and 7%. A HELOC it's probably going to be a little bit more than a 30-year fixed, right? Because it's a second mortgage. So we're looking at 9%. Let's just plug it in, right? Whatever. Your total payment, the total cost for you at the end of 30 years is going to be $130,000, which is the same thing as 45,000, which is the principal, plus an additional 85,000. So the HELOC is gonna cost you about 130,000. So let's go back to our when we compare it, a HELOC is gonna be $130,000 for a principal borrow of a principal amount of 45,000, and you're gonna end up paying 130,000 over the entire life of this loan if you hold it to maturity. Okay, if you hold it the full 30 years, and you're making all the payments. So look, I mean, even in the most like conservative case, that over the course of 30 years, you're paying so much more for an HEI or an HEA. Can you compare these two? $200,000 on top of the principal, $81,000 on top of the principal versus $85,000 on top of the principal. Usually people, how they exit out of a HELOC is they refinance, right, when the home appreciates, or they sell the home. And your home has appreciated enough to cover the additional the principal And that's how people usually exit a HELOC. If you want to use that same strategy on an HEI or an HEA, you're going to get fleeced. They take a percentage of that equity and you're left with less than what you started with. Okay, so is it worth it for that 45,000? I mean, you make that decision. It's your money, right? I'm not your financial advisor. I'm just doing the math for you here. But if it was me, definitely not. My house if I were to live in a house that I own, I'm paying mortgages on, I'm building equity, I want this to be passed down to my kids. Even if I'm falling on hard times, even if I can't, I lose my job and I can't make the payments, I would rather sell my house and scale down my lifestyle than do something like this. There's a famous story about, to protect this person's name, we'll call her Peggy. She's from Washington State, an elderly woman. Elderly and disabled woman. She signed a HEA, got $30,000 because she wanted to consolidate her debt. But she didn't just stop at $30,000. She saw that there was enough room she could take out more. So she took out $100,000 from her home using the HEA, used 30% of that to pay off her credit cards, has 70% left over to live. At the time, her home was worth $200,000. By the end of the HEA contract, her home was worth $450,000. It appreciated $250,000. The HEA company took 70% of her home's equity at the end of the contract. This is robbery, you guys. This lady got fleeced. She got her home taken away from her for $100,000. And she tried to refinance this and they wouldn't let her refinance it. There's clauses in the contract where it prevents you from refinancing your HEA or HEI contract. You're locked into this. So, I can't tell you what to do with your money. I can't tell you what to do with your assets. It's your choice. What I'm here to do is sound the alarm and show you that these products sound great at the beginning, but you really need to do your diligence. You really need to do the math and see what the downside is for you. Use tools like AI, ChatGPT or Grok or whatever. Use people like Jason and Nikki and me. You can DM us or you can contact us through the link in the description for a consultation. And if this is something that you're looking into, bring it up to us and say, hey, I have this term sheet from an HEI or an HEA. Can we compare it to your HELOC product, something that I qualified for, and see if it makes sense to go with the HEI or HEA versus a HELOC. We're legally obligated to show you the math and tell you what's the most beneficial route for you. So yeah, just wanted to shed some light on this. These are, in my opinion, predatory lending practices that honestly shouldn't be allowed. For the vast majority of people who are paying mortgages, building equity, you're doing this for a reason, for the future, for your kids, for the next generation, or XYZ, whatever it is. And you don't want to fall into a trap where you're going to lose out on the vast majority of the equity in your home. So be safe out there, do your due diligence, use people like us for second opinions. Again, there's a link in the description for a one-on-one consultation with us. No pressure. It's free. It's just for clarity and for your benefit. Okay, and if you got this far into the video, thanks so much. If you're not subscribed, please subscribe, comment, and like the video and do all that, algorithm stuff. It really helps us a lot. All right, thanks for watching, everyone. We'll see you guys on the next one. Bye.